Dave Bechtel, you go both long and short in the Barrow Long Short Opportunity Fund. So what's life like as a short seller ever since that mid-February turnaround in the market?
Being a short seller was great during 2015. It protected our long positions from market risk that we were seeking to hedge. And we ended up about 8% on the year in 2015 as a result of that. First month of 2016, the shorts also played an important role in protecting our capital. We were up again in January. So far in February, it's been a little bit more of a mixed bag. We've seen a junk rally in some of our short names. These are companies that are low-quality stocks, trading at obscenely high multiples. And our philosophy around quality and value is we're looking on the long side for high-quality names that trade at a discount to intrinsic value. On the short side, it's just the opposite. Junky stocks that are priced way too rich. And we're not looking for them necessarily to go to zero, but we are looking for them to underperform the market.
All right, well, one stock that you don't like is Crocs. This is a fad stock that was above $70 a share back in, I think it was 2007 or so. Now it's at $10. So how much lower can it go?
We think it can substantially underperform the market from here on. They just announced earnings yesterday, lost about $100 million over the last year. Not a great showing. They also shrank their revenues by about 2% year over year and recently lost a patent design case. So we don't think that the company is well positioned to outperform over the long term.
All right, well, you're also short Abercrombie and Fitch. Now, this stock, it's up, I think, over 7% year to date.
Yes.
But a lot of that might be due to a short squeeze because 35% of the shares are sold short. So that could create some difficulties for you, right?
One could say it's a little crowded, but it's not a surprise that so many people don't like this stock. It was recently in a survey, the American Consumer Satisfaction Index voted as the most hated retail brand in America. I'm not sure it has a lot of legs from here, frankly, Greg. They're not growing their revenues. Their same-store sales have contracted every quarter for the past 10 quarters in a row.
All right, well, speaking of short squeezes, Groupon. This stock's up around 56% year to date. It seems like it doubled this month because of an investment by Alibaba. So how do you play a stock like Groupon?
Groupon is another one of these stocks that we're not expecting to go to zero. We're not saying it's a big fraud like a WorldCom. We're just expecting it to underperform and to serve as a hedge for some of the other names in our long portfolio. In Groupon's case, it has revenue growth of about 2% a year lately, and it's trading at about a 2,500 times forward price to earnings multiple. We think that's too expensive given the lack of growth.
All right, well, thanks a lot, Dave.
Thanks, Greg.
And thank you for watching The Street.